The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
U.S. stocks slip while Treasury yields climb. Traders recalibrating bets after that latest batch of inflation data. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. We're around the lows of the session. We're not getting any record highs today. Let's check in on those markets here. You got the S&P down by 0.4%, the Nasdaq 100 off 0.5%. So trading heavy around the lows, kind of deteriorating as we go. It's hard to find a real narrative, though, with what's leading the equity markets lower. And the VIX picking up a little bit, but we're still under 14. So you could make an argument that there might be some complacency to that as well, Romaine.
Yeah, 4.2 right now on a 10-year yield. Yields right now continuing to extend that climb to the highest level since at least late November. And that suggests traders are growing a bit more cautious on whether Jay Powell actually follows through on all those rate cuts that were sketched out in that last dot plot. At least one whale of a trader opening a large option strategy that does pay off should yields jump at least a 0.25 percentage point within the next 6 weeks. It's a big wager. And of course, that would also mean downward pressure on Treasury prices and potentially downward pressure on stock prices, too. Stocks that, as a group, are hovering near overbought levels and losing steam. In fact, despite the record highs for the major indices this week and last, a Bloomberg tracking portfolio of pure momentum stocks, which has been the best performing equity factor all year long, that's down almost 2% since its last record just 4 weeks ago. A separate gauge of momentum that compares buying to selling strength for the S&P, that's been on a daily stair-step slowdown since peaking back on November 26. And that sets us up for an intriguing test tonight for chip stocks and the big tech names that have been overwhelmingly responsible for this year's rally. Broadcom, which has surged 59% this year, including 10% in the past 2 weeks. It's got a lot to prove when it provides that quarterly update in just about an hour's time. Investors looking for confirmation of any kind that AI-related growth is real and that the historic bid higher on tech stocks this year was justified.
Huge. And also really talking about how expensive tech stocks really are any way you slice it. And here's one way to slice it. This is the earnings yield spread between the Nasdaq 100 over the 10-year Treasury yield. So when this line goes up, it means the Nasdaq 100 yields more, prices are lower, therefore they're more attractive relative to bonds. Now, when it goes negative, it means that bond prices are more attractive than stock prices. And right now, we're almost at negative 2%, that spread between the earnings yield for both. Raises the question, one, if yields actually don't go any lower from here, what winds up happening to the equity market, and particularly tech, if tech has already priced in those lower yields? And the question also is, what happens if yields actually go up, a la like we're seeing today? What kind of pressure does that exert over the long run when it comes to equities, Romaine?
And of course, that has to be factored in. Right now, that 10-year camped out at 4.3 and change. As we kick you off to the close here on this Thursday afternoon, we're joined here in Studio 2 by Jimmy Chang, Chief Investment Officer with Rockefeller Global Family Office. Jimmy, great to see you. And I do want to start off with this move in yields. I thought we would be talking right now about a significant drop in yields. We got a bit of a drop coming off of that last rate cut. It's kind of stalled since. And now you're seeing a lot of people close out long positions and now start to talk about this idea that Treasury prices will go down and yields might creep back up closer to 5%.
Yeah, you may recall on election day, the 10-year closed at 4.27%. After that, there was a concern that the new agenda will likely drive inflation and growth both higher. So on an intraday basis, I think the 10-year peaked around 4.5%. And after President-elect Trump nominated Scott Bessent as the next Treasury Secretary, that was well received by the market. So immediately the market reacted, the yield came down, went to around 4.15%. In the last few days, I think is this growing concern that perhaps inflation is kind of sticky. It's kind of stagnating rather than heading lower. So I think that's just the usual trading. I think we're in a range. Mm-hmm. So long you keep it under, let's say, 4.5%, I think we're okay. Mm-hmm. If yield spikes above 4.5%, that offers a clear path to 5%, at which point I think it will pressure equity valuations.
Talk about how that correlation works. I mean, because we talk about this idea of a big rally in a lot of names that were benefiting from a drop in rates and what most people assume was going to be a continued drop in rates in 2025. If we don't get that, that's the end of the rally, equity rally?
I think the drop in rates is more on the short end. The expectation is that the Fed will probably take the Fed funds rate to at least, say, 4% or maybe in the high threes. So the short end will move lower along with the 2-year Treasury yield. But the long end is really up to the market. The Fed has very little control over it. And that depends on the prospect on growth, inflation, and deficits.
What happens if we actually don't get 4.5% with the 10-year, but we don't get materially lower? Like we don't go to 3.5%, say for the 10-year. Is that enough to say pressure equity prices at the end of the day?
I think if we stay in the range, let's say 4 to 4.5%, that will be okay to the market. That's probably fair value. So if you assume long-term economic growth around 2% real, inflation around 2%, assuming the Fed achieves its target, you're looking at 4% nominal GDP growth. And in the long run, the 10-year tends to trade around the nominal GDP growth rate.
How expensive do you think equities really are right now?
They are very expensive relative to the 10-year yield at 4.3%. So I would say historically, at where we are with the loan bond yields, the PE fair value is probably, let's say, 17 to 19 times. We're currently at 22 times 2025's expectations. So that's expensive. But it doesn't mean it's not a timing indicator, so it doesn't mean that market will correct fairly soon. It can stay elevated for a while. A lot of that has been driven by, obviously, the euphoria and the fund flow and very favorable liquidity backdrop.
I am curious, when we talk about this rally, obviously a lot of this rally, at least this latest extension of it, has been because of the election and the optimism around what a Trump administration might mean for financial markets and more broadly, I guess, for corporate America overall. In a very symbolic gesture, of course, he was down at the New York Stock Exchange earlier this morning to get his Time Man of the Year award, ring the opening bell. But really, the excitement that you saw on the floor, and as well as some of the reception that you've seen in financial markets, is that overly euphoric? Do you think that optimism around what his administration could mean for asset prices, has that been overdone?
I think directionally, everyone is excited about deregulation and having an administration that's going to be pro-business, having a president that pays attention to how the Dow index does. But that said,
the Dow. Said. Okay.
Yeah,
okay.
See, we care about the Dow now.
He is old-fashioned. But with that said, I do think the euphoria may be a little bit carried away, just because some of these policies are going to be somewhat disruptive to the market, at least in the short run. So let's talk about tariffs, a tighter immigration policy. Both will likely lead to potentially higher inflation, placing more wage pressure, and that will also affect several industry sectors. Talk about construction industries, finding qualified workers, or multinationals dealing with an appreciation, an appreciating dollar, and also potentially retaliation from other countries.
Yeah. Are there pockets of this market that you're embracing as an investor that you think are going to directly benefit from his policies, or at least the ones that he's promised to implement?
If you look at the America First agenda, I think that tends to focus more domestically focused companies, and you find many of them in mid-cap, quality small-cap companies, and they have been lagging mega-cap. So from a valuation standpoint, from a regulation standpoint, both are in their favor.
All right, Jimmy, great conversation. Always wonderful to talk to you. Jimmy Chang is the Chief Investment Officer with Rockefeller Global Family Office, kicking us off to the close here on this Thursday afternoon. When we come back, we're going to talk about those tariffs as U.S. importers are already accelerating shipments as the trade wars threaten to heat back up. We're going to talk about how the West Coast ports are handling record volume and what it means for your packages this holiday season.
Plus, big news from Warner Brothers Discovery, sending the stock soaring, why the media giant plans to split its businesses into two with an umbrella company next year.
And we continue to remember the life and legacy of TPG co-founder David Bonderman. We're going to talk to one of the people who knows him best. A sit-down conversation later this afternoon with Jim Coulter, a founding partner of that firm. All that and more coming up in just a bit, right here on The Close on Bloomberg. All right, the incoming Trump administration here in the U.S. is squarely focused on cutting government costs, and that could include Well, cutting some of the U.S. agencies that provide vital economic data that often moves markets. Molly Smith is the editor here at Bloomberg News, and she joins us now to talk about today's big take. And this has been a topic of conversation in Washington as long as I can remember. I started my career in Washington, I'm not going to tell you how many decades ago, and they were talking about, restricting funding for a lot of these agencies, and the agencies don't do that. There's no way we're going to be able to cobble all this data together. But the world has changed a lot than what it looked like 20, 30 years ago.
Yeah.
And it gets to this question here as to how much can be cut from these agencies without actually affecting their output and productivity.
Well, that's what we're looking at now, and these agencies are really just struggling with the funding that they have already, and it's already not enough before you're looking to even cut it. So what got me interested in this story was when the BLS said back in June that they were going to have to cut the sample size of the current population survey. And that's the one that produces the unemployment rate and the jobs report. It's super important, provides a ton of statistics about demographics of our labor force. And that was going to be a really drastic decision that without some emergency funding that came through a couple months ago, otherwise would have taken effect early next year. But the thing is, the threat is still there. This is just temporary funds. So without getting a permanent increase in appropriations, the sample size threat is still very much alive.
We talk about how much the markets depend on these reports, whether it's the monthly reports or anything in between. Do people in Washington value this data? Do they value these reports? Because when I hear about cutting from these agencies, this isn't just about we don't think these reports are valuable. This seems just to be a wholesale, we don't understand what you're doing, or we don't like what you're doing, and we're going to take funding from you.
And that certainly seems to be the theme that came up with all of the people who I spoke to, is that there seems to be a lack of understanding in Congress among the lawmakers of just how important these statistics are and why we need them. And that's why decade after decade that a lot of these requests for extra funding have gone unanswered, and this kind of funding is to support more data collection that we don't have in the economy right now still, that a lot of the data that we even have now still would suggest that we are more a manufacturing-driven economy rather than a service-driven economy. And that's been, that was decades ago that was the case.
So given that, and given that responding to this survey data can also be super spotty, is there a case to be made that we need a different type of data collection? Or like the Fed does their own regional surveys. Like, do we use that instead of these federal surveys? Why bother at this point?
They all definitely serve a purpose, and the Fed regional surveys are really, again, manufacturing. So to talk about the abundance of data that we have on that side of the economy is really striking when most of our economy is driven by services. So they really all work together. Fed data is super important. BLS, Bureau of Economic Analysis, Census. I think what the real importance is, and hopefully this is something that maybe the incoming administration would want to address in this push for efficiency, is breaking down silos so that these agencies can work more together, can share data a bit more easily, have access to similar administrative records so they don't have to ask households for as much of this information that maybe already exists elsewhere.
But that's what I want to know. Are there proposals to fix this? It's one thing to say we want to cut money. That's not a fix. That's just doing away with it. And also to Alex's point, too, we talked a lot this year, particularly in an election year, about the disconnect of what we saw in the data and what we saw amongst real people on the ground and the anecdotal evidence they were getting. The idea that the data said the economy was fine, and a lot of people, if you talk to them, they're saying, I'm not fine. Right. And there was a disconnect, and it was a real disconnect. What's the solution?
Unfortunately, you need money to produce these statistics. That's just the end of the day. This doesn't come free. And, somebody who I spoke to for this story is the chief statistician at the OECD. And he made this really excellent point that there's this maybe misunderstood belief out there that since there's so much data sloshing around that it's all just free, that we just have this. But it doesn't just appear. It takes money and resources to collect this data, to analyze it, to then broaden it out to a sample that's more representative of the entire population. And that just takes time and resources to do. And especially when you're looking at declining response rates, you need to have a more efficient data collection method. That also takes money. Right now, the BLS and Census Bureau call people every month to ask them about what employment is like in your household. Certainly, the internet would be the way to go for that. But again, you need money to set that up.
To change that. Also, what will we do at 8:30? If we weren't able to talk about or trade the CPI or PPI.
This whole show, what would be here?
Right, well, we would do stocks, so we would be fine. It's the morning show that would
I'm not sure about surveillance.
Yeah. All right, Molly, thanks a lot. Molly Smith, editor over at Bloomberg. Thank you very much.
We are okay, right?
No, we're totally fine because the New York Stock Exchange is still open.
She scared me for a second.
Shush. No, that's just the morning show. Okay, coming up, a conversation with Mario Cordero, a chief executive officer at the second busiest port in the nation, the Port of Long Beach. This is The Close on Bloomberg. It's like 2 weeks till Christmas, and you get U.S. freight shipping volume jumping in November. That's according to Cass Information Systems. Shipments rising 2.8% last month. Data from the National Retail Federation also expects traffic at U.S. ports to get even busier, and part of that, not only Christmas, but to front-run potential tariffs from President-elect Donald Trump. Joining us now for more is Mario Cordero, Chief Executive Officer at the Port of Long Beach, which is the second busiest U.S. port. Mario, just give us broad strokes first. What is flow like right now? What's coming in? How easy is it to offload, and where is it going?
Well, thank you, Alex. First of all, it's a very robust movement here at the Port of Long Beach. You know, our October number, we moved 987,000 TEUs. That's a 113-year record. In other words, historical record. So it's very robust. No delays, no congestion, no bottlenecks.
What do you make of the strength? Is it a consumer demand? Is it a holiday demand and the season is going to be really good? Is it stockpiling into the new year? What is your read on that?
It's all of the above. I mean, the good news is, Alex and Romaine, a couple of years ago, we were talking about whether or not we were going to have these goods on the shelf during the holiday season. So what a big change now. Consumer demand continues to be very robust. On the other hand, we are benefiting here in the San Pedro Bay complex from the ILA discussions, the labor discussions in the Eastern Gulf, which some of that cargo is being diverted to the West Coast. And in addition, the whole issue about the tariff discussion has caused our shippers to kind of front load some of the imports. So we're seeing those two factors leading to the surge that we've experienced here in the last quarter of 2024.
I'm curious, Mark.
2025.
Yeah, gotcha. I'm curious, Mario, if you just kind of explain for our viewers, too. I mean, when we talk about what goes down at the Port of Long Beach, the majority, right, or the biggest percentage of stuff coming into that port is coming from China. Is that correct?
Absolutely correct. I mean, it's over 2/3 of our imports come from China here at the Port of Long Beach.
And so if we get like an increase in tariffs, and we already have those tariffs in place, so if we get that extra 10 percentage points or whatever the Trump administration has said that it might impose, would that materially change the flow of what's coming from China? I mean, I understand how new tariffs on Mexico and Canada would certainly change flows, but does an additional 10 percentage points really change much for what people would be buying?
Well, given that we've been here before with regard to the initial tariff implementation in the first Trump administration, which actually was continued by the Biden administration, I don't see a material change that's going to impact the flow. I know that, again, we don't know exactly what that looks like in terms of what the plan, but preliminarily, I mean, we can't be dismissive of the concern that it could impact our import volume and export market. But again, we've been in that tariff environment now for a few number of years.
How do you see the pricing for that? Like, if we do get tariffs, which then affect goods coming in, like, who winds up paying for that at the end of the day?
Well, initially, when we went through the tariff discussion or the experience in the first Trump administration, and again, continued by the Biden administration, initially the shippers kind of bore the cost. In other words, they didn't pass that on to the consumer. However, as we move forward to a couple of years into that tariff implementation, they started to pass that on to the consumer. So we do see that this potentially could have that residual passing on that price to the consumer and to our business entities.
Talk a little bit about labor for a moment. Obviously, you guys aren't involved in the International Longshoremen's Association issues with the U.S. Maritime Alliance. That's affecting the Gulf Coast as well as the East Coast. What's your read on that? Are you noticing anything that flows that are happening in relation to that?
Well, from the San Pedro Bay complex here at the Port of Long Beach, which includes Port of Los Angeles, as I mentioned, we are getting that cargo that's being diverted from the East Coast to the West Coast in a percentile that's healthy. Part of the reason why we have record volume here in the West Coast, particularly here at the Port of Long Beach. So as those negotiations conclude, hopefully, at the beginning of next year, we'll see what happens. And again, my view is that the sooner they come into some solution, the better, because any disruption in supply chain in the nation is not good for the nation's supply chain.
I am curious about some of the modernization efforts that you spearheaded, Mario. I know we talked a lot during the pandemic when every supply chain around the globe had basically been hobbled, and that required a lot of soul searching and a lot of reflection about what a port is supposed to look like, how it's supposed to operate. And I know you spearheaded some changes there. You got some help from the government as well. Is that going to insulate or maybe buffer any sort of potential disruptions that we get in 2025?
Well, it's certainly going to mitigate that potential of disruption. So, for example, as you know, I was a spokesperson for 24/7 operations, admittedly framework of a 24/7. So we have expanded hours of operation, which again accounts for the reason as to why we don't have any bottlenecks or congestion here at the Port of Long Beach. And in addition, the emphasis of cargo, that is on-dock rail movement. Port of Long Beach have invested about $1.5 billion in one of our state-of-the-art endeavors, the Pier B Enhancement Rail Facility. So that's the future in terms of how we put more of this cargo on rail to facilitate, again, not only expediency, velocity, but also, again, to make sure that we get the container out of the terminal ASAP, including the fact that the staging areas, we did a big staging project here at the Port of Long Beach when we had the worst scenarios in the San Pedro Bay complex back in 2021. And again, we continue with that model today.
Have you had any direct communication at all with the president-elect or his surrogates?
No, we do expect to have communication with the administration next year. I mean, that's been the practice of the Port of Long Beach. When we have an administration, whether it's current or a new administration, we make sure that we have those discussions of collaborative spirit with the administration. So that's the practice, and we expect to continue that in this new administration.
All right, Mario, I appreciate you taking time for us, and we'll check in with you early in 2025 to see how things are going. That's Mario Cordero. He's the Chief Executive Officer for the Port of Long Beach out there in California. And yeah, we talked to him a lot, Alex, during the pandemic, you remember, and it was all about, how do you sort of adjust to this new world order? And then it just seems like now everything's getting back to normal, and here comes Trump 2.0.
Yeah, but look at C.H. Robinson, for example, logistics company, second best performer within the S&P. It's at a record high, had a good investor day. I mean, it's underlying a very strong economy, which sort of echoes what you were talking about with Trump on the New York Stock Exchange, right? Like that feel of a lot of optimism.
Yeah, absolutely. And of course, with just 2 weeks to Christmas, less than 2 weeks, I believe now, Alex.
I'm done. I don't
a lot of folks
anymore.
have already bought their stuff, so maybe your Christmas presents won't be disrupted by the issues at the port. But what about your returns?
I'm big on returns. Coming
back, we're going to speak to the CEO and co-founder of ReturnPro about his outlook for the holiday shopping return season. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
I'm Alex Steele, and we're around the lows of the session right now. The S&P down by about 0.4%. BTIG writing like, look, if you can't broaden out a rally now that's supposed to be Santa Claus rally, what does that mean for January?
That's what I'm curious about. I mean, yesterday we were talking about that record on the NASDAQ, and it was a narrow record driven by big cap tech. And it was sort of like, well, what happened to the small caps and the mid caps and the cyclicals and all that rotation we were talking about? Is that just on pause? Or is it over?
But this should be the Santa Claus rally, right? Like this should be the window dressing part. So if you don't get that, what does it wind up meaning then for January? Are we just not going to broaden out here? Yeah, and it gets to this idea, too, that we're talking about a lot of stocks that are much more economically sensitive. They're going to be much more sensitive to changes in policies coming out of Washington. And maybe people are a little nervous about that. And maybe they're nervous about how the holiday shopping season has stacked up so far. I don't know if you finished your shopping. I've done my shopping. I have to admit, I go through, I'm a little anal, so I went through all my spending. I've actually spent less this year than I did last year. Not intentionally, but it's coming in significantly below what I did last year. I round. I think it's the same. It's the same. It's fine. It's all fine. I shopped on sale. I don't know what she's saying. Well, for a lot of folks here, this is the season to be shopping, and we're all happy to shop, but there's also comes a bit of dread when it comes to the flurry of returns, at least for retailers. That's where a company like ReturnPro comes in.
The company helps to simplify the returns process for its clients, like a Walmart, like a Sam's Club, by increasing profit recovery and reducing waste. I'm pleased to say that the co-founder and CEO of ReturnPro joins us now. Senator Shamiss joins us here in Studio 2. You must be a busy man this time of year, as of course, I would assume this probably has to be, obviously it's the biggest time for shopping, but I assume come December 26th and beyond, it's probably one of the biggest times for returns as well.
First of all, thank you very much for having me on. It's the busiest time for us, of course, and the problem is massive. A lot of people don't know this about returns, but it's about an $890 billion problem in 2024. That's the estimate, which represents 16.9% of everything sold consumer in the United States. Well, if you look at most companies, they don't even have a 16.9% margin. So, I mean, solving returns really adds to the bottom line. Every retailer, every brand.
Well, this is what I've been curious about, particularly in recent years with the growth of e-commerce, is how easy it is to return something. And I always scratch my head, as a consumer, it's great, but I always scratch my head, is like, how do they make money off this? Because sometimes they either keep the product or they just trash the product. And I'm just like, are they making money on this? So you come into play as a way to try to sort of thread that needle of finding that balance between keeping the customer happy, but also keeping the retailer profitable.
Well, you're paying for it. That's how it happens.
Okay,
that's 16.9%.
That hurts to know, but thank you.
But it's built into the product, and that's what it is. Most of these brands and retailers build it into the product. What we offer is a service that says, okay, let's look at this process. How do we fix that? How do we reduce the rate? The most important place to reduce returns is the pre-purchase. We want to stop returns as much as possible. How do we get better sizing on these sites? How do we get a better experience for the customer so the return doesn't occur in the first place? Then, of course, if the return does occur, what do we do? What do we do with that product? How do we make sure we don't lose that customer? Because most 78% in our survey of customers basically won't shop at that retailer if the retailer provides a bad returns experience.
Oh, wow.
And then no matter what, the return's going to occur. It's going to happen. So what do you do with that product physically? How do you get back on that shelf? And that's the most important part of returns, is solving that.
So give me a success story that you guys have worked with. You don't have to name the company, but give me a success story of like, okay, this is how we used this software, this is how we use this to transform how they do returns.
So a big part of this is looking at the pre-purchase, and getting most major retail to deal with, like big box, to deal with pre-purchase is difficult because you're kind of dictating the business to them, and they don't like that, of course.
And by pre-purchase, you mean that like I pick the right size in my outfit, or like I get the right one that I need?
We encounter you at the template piece, right? While you're shopping, we're doing things on that template to make sure that the sizing is correct. If you're buying an item from a specific brand and the size is X and you go to a different brand, we have to associate that size because they don't match. And it's a very complex industry. So that's a pre-purchase, and there's a lot of room on the pre-purchase, but a lot of it happens on the returns experience itself. How do you build the right page? How do you make sure when they come to that return, they're comfortable? How do you communicate the return policy in advance? And then, of course, how do you handle that product all the way through? We took a company, it was a retailer, I don't want to mention which one, but not very big, let's call it 500 stores or below. They were losing about $1 million and change on their returns. Now they're making about $5-6 million. So it turned into a profit center, and that's a big deal. All they were doing before that was just sorting it out. Now they're adding value, adding value, adding value. And that's the idea, right? The idea is, how do you get them to turn returns into a profit center? And how do you educate the consumer? We're a B2B business, right? We're not in the consumer education, but what we found is we have to evangelize it, because we have to tell people this is the result of your shopping habits. And if we do a better job as consumers shopping, we just have better experience.
So the smaller retail chains can take advantage, because I look at a Walmart and I think, okay, they have deep pockets, they can sort of find a way to figure this out,
One of our biggest
hire companies like you. But for the smaller retailers that don't have the deep pockets of Walmart, do they have a shot?
They do. We have we have three types of services. We have SMB product, we have a medium-sized business, and then an enterprise business. Of course, the enterprise is extremely handled, very specialized, but there's a lot on the 3P seller side. The way I divide the world is into direct-to-consumer, first-party sales, which are like the brands that are selling into the big boxes, and then the 3P marketplace sellers. And there's a mix. You know, you can have a big first party that has a small direct-to-consumer and a small 3P. And you have to be able to kind of solve everything for them. So they all want to see it under one platform and deal with it. And within that solution is the solution for the 3P or the SMB, right?
Yeah, I want to ask you too about the distinction when we talk about returns. I mean, there are people who return things for a legitimate reason, wrong size, or they didn't like the gift or whatever. There's also a fraud component in the return space as well. And I'm curious as to how you address that? How do you root that out? Or more importantly, how do you even prevent the fraud from starting in the first place?
So there's a lot of preventative tactics. There's something called the trusted algorithm, and almost every major retailer has it. Even companies like Shopify have third parties that provide trusted algorithms. And there's companies out there that literally build software that produces trusted algorithms, but at the end of the day, that's not enough. You have to be able to track the package all the way through its return. You can have a lot of fraudulent product coming through the system. How do you know which ones are fraud? How do you communicate that? If you're liquidating your inventory, do you know what you received in fraud, or are you just literally paying out that amount? Companies like Lacoste, for example, has a new system where they use special technology to take 3D scans of their clothing, and they know what's fraudulent, what's not. I read an article recently. There's a lot of really cool tech out there to stop fraud. And there's two types of fraud. Bracketing, which is not bracketing, but wardrobing, which is very consumer-based. It's kind of like you want a cocktail dress, you buy it, then you go return it.
Oh, yeah.
Then there's organized fraud, which is a completely different story, which are people really, there's organizations out there that are built to take advantage of these retailers within a fraud environment.
All right, Senator, thanks a lot. I really appreciate it. That was really...
Yeah, well, I was going to say, man, my wife were at a gala, and the woman sitting next to us, her tag on her dress was showing.
You know, I mean, she had to take
Price
it for a
tag.
spin, though. Like,
And
she
we didn't
had
want
to
to say
see if she
anything,
liked
but
it.
we were like, okay, we know what's going on. Anyway.
All right, Senator, thanks a lot. Senator Shamiss, co-founder and CEO of ReturnPro. Did you ever get those things where, like, you bought something, tried to return, they're like, you know what, just keep it?
Yes, all the time.
It's
And it's
crazy.
outside. We bought a desk once.
A desk?
I'm not going to say from where. And there was a piece missing. And we asked if they could send us the piece so we can finish putting the desk in. They were just like, we're just going to send you a whole new box. Because I guess it was more efficient for them just to send us the whole thing. And they said, do whatever you want with it.
Wow, that beats mine. I had lamps. I got 2 extra lamps, but a whole desk. That's something. Yeah. All
Maybe
right.
we can trade.
Okay. Coming up, Warner Brothers Discovery is setting the stock soaring here. The media giant planning to split its business into 2 next year in hopes of future deals. We'll break down what's happening with that company next. This is Bloomberg.
All right, it's time now for our stock of the hour. And I want you to take a look at Warner Brothers Discovery. A 14% jump in that stock today. This after the media giant announced plans to split its cable assets and streaming businesses into 2 separate divisions. Of course, Warner Brothers Discovery is the parent company of CNN and HBO and is aiming for future deal making and strategic opportunities as cable TV viewership declines and streaming continues to grow. Isabel Lee joins us right now, who helps to cover the stock market for us here at Bloomberg. And while this isn't surprising, we kind of knew something was afoot with Warner Brothers and, quite frankly, with all of kind of the legacy media companies here. The price reaction, though, in the stock, though, it's enormous. All just simply because they're splitting into 2? What gives?
You could see it as a bit of an overreaction, but it's not that surprising because the industry has been really going, I don't want to say going down the drain, but it has been. And this comes after Comcast announced it would spin out. Remember that big news a few weeks ago when they said it would spin out CNBC, MSNBC, USA. So it's not that novel in the industry, but it is great news for the company. So they will divide it into 2. And earlier, actually, it rose to as much as 17%. That's the highest since April 2022. They expect this to be finished by mid next year. And it really comes at a time when we have even Disney CEO Bob Iger saying that one of his firms, which is ABC, may not be core to the company. And you have Paramount's Jeff Shell saying that they will manage CBS cash flow more aggressively. So it's really not that much of a surprise, but I guess it's good news. Investors like it.
Well, here's what I find so interesting is that what it means for the future, because the linear part, that's what still makes the money. And then you have the streaming in the studio where the future is. So it's like you can't divest it right away because you still need all the money from the linear TV, but you need to set it up in a way where the new stuff can eventually make money. And I find the timing of that and the sequencing of that to be really confusing and interesting.
That's exactly right. We have Bloomberg Intelligence saying that this is, of course, for deal making and the consideration of a separate of units is the big deal, but 85% of its profits is still tied to its legacy TV business. So this may be tough to execute, and I think it's going to be messy. You know, they're saying it as something that's easy. It'll split into 2 divisions, one this, one that, but then how exactly? I mean, it's probably going to be as tough. But Bank of America did say that they believe in the hidden value of the company, and they see this as a step towards that. So it's really just unlocking of the potential. And I guess it's easier to sell or manage companies when they are smaller units.
I am curious, though, too, about the sort of strategic initiatives. I mean, it sounds, when I was kind of reading in between to the lines of some of the language they're using, it sounds like there is an acquisition strategy in here somewhere.
I also got the same hunch, but then it won't be a surprise because Warner Brothers isn't really a stranger to that. Like if you look at the timeline of their company, they merged with Discovery, they were acquired by AT&T, they merged with New Line Cinema. It goes back all the way till 1923. So maybe they are open to that.
I like, I have the Discovery, what is it, Max now, right? It's what they call it, and they put everything under one umbrella. That's my favorite streaming service.
Is it?
Yeah, because they have so much content. It's like, it's just like, because they have all these channels and all this legacy content is just all in there. And
well, that's why they need the movie studio too, because the movie studio is going to feed the streaming beast at the end of the day.
I don't know. Yeah, you would think so.
I mean, I think that's the goal. That's why they're going to be together versus the linear.
Maybe you should be CEO of one.
Me? No, I just get my stuff from Paul Sweeney. He's a former M&A banker, so we just talk about this in radio all day. That's why. All right, Isabel, thanks a lot. Isabel Lee joining us from Bloomberg. Warner Brothers stock up a nice 14%. Again, Romain, taking a look at the market, you're looking at S&P down 0.4%. So, we're right around the lows. The Nasdaq off by 0.5%. And now I'm going to start quoting the Dow, since President Trump-elect likes it. That's also down by 0.4%.
Jimmy Chang threw me for that one, but I guess, he loves it. Kind of interesting, though. Dow Transport's actually in the green on the day.
Really?
Yeah.
That's
only by 0.1%, but still. I mean,
but still, that's something.
Trend just a little bit.
And you got the Russell, though, around the lows of the session as well, off by over 1%, really underperforming. All right, we're 15 minutes away. We'll take it to the closing bell. Marc Pinto, head of American Equities with Janus Henderson. This is Bloomberg.
Historically, at where we are with the loan bond yields, the PE fair value is probably, let's say, 17 to 19 times. We're currently at 22 times 2025's expectations. So that's expensive. But it doesn't mean it's not a timing indicator. So it doesn't mean that market will correct fairly soon.
Rockefeller Global Family Office CIO Jimmy Chang kicking us off about 50 minutes ago, talking about the potential extension of this rally. But as he said, Alex, stocks right now are not cheap at all, and there are a lot of risk ahead here to the momentum.
And here's the thing, you can have a million charts that tell you that stocks are expensive, and those exact charts would have also been there 6 months ago, a year ago, 5 years ago. So it's hard to know then what that actually means. But what we do know is that the trading is a little bit heavy today, particularly when it comes to the Russell 2000 really underperforming. And I mentioned the broadening of the rally that we saw for a moment. If we don't see that continue, what does that mean headed into January?
Yeah, and absolutely. And I don't know if the broadening is necessarily over, but I'm always astonished at how quickly we see these sell-offs in the Russell, Dow Transports, and in the mid-caps. After, you get these sort of upswings and then people get a little jittery about rates or whatever, and then they immediately sell the stuff off. Where is the compound?
Yes, exactly. Bloomberg Intelligence was saying that, look, the earnings expectations for next year for the small caps are so much lower, that the bar to beat is so much lower, that maybe that finally provides that rotation that we've been talking about.
Yeah, and that's a good point, particularly given when you look at the Mag 7 and some of the big cap blue chip names, as some call them, Alex Steele. There's going to be looking at some interesting year-over-year comparisons next year, given what we saw this year. Marc Pinto joins us right now. He's head of America's Equities with Janus Henderson Investors as we count you down to the closing bell. Just 8 minutes to go. And Mark, when you look at that rotation, that great rotation of 2024, that I guess for right now is on pause, do you see some hope that we are going to see that broadening of the rally sort of re-up itself at some point soon in 2025?
Yeah, I think we do. We definitely saw a shift in July of this year, where we saw as we like to call it, the other 493 stocks in the S&P 500 start to get some attention and perform well, and I think that will continue. We're very positive on the Mag 7 and the opportunities there, and they're at the valuations they are for good reason. But we do think maybe the risk reward is a little more attractive looking at the rest of the market and the broader market, where the valuations are substantially lower than the headline number on the S&P 500. And so we're just saying that we think that could be the better risk return today.
Now, the flip side of that, when we talk about the big cap names, and let's just take the S&P, the SPX, the cap-weighted index here, and you look at the aggregate valuations by historical measures, yes, definitely expensive. there is an argument out there, Mark, and I'm sure you've heard it amongst on Wall Street, that when you consider economic expansion, when you consider some of the optimism about what some of President-elect Trump's policies could mean for corporate America, that maybe those valuations against that backdrop on a forward basis aren't as expensive.
Yeah, and certainly there's an argument to be made that the valuations for companies like NVIDIA are still actually very attractive, notwithstanding the move and the size of their market cap. But what we're saying is we think the risk reward is better away from those names right now. And again, we don't think they're going to underperform. But if you look at the entire small cap index, the total market cap of the small cap stocks, it's about 4% of the total market value. Put it differently, the entire value of the Russell 2000 index collectively is equal to NVIDIA. And, if it were to go back to its historical level, which is about 7.5% of total market value, for that to happen, small caps would have to outperform large caps by 90%. So again, it's just a matter of degree and where the best risk-adjusted return is today. And certainly we're not making any negative statements on the Mag 7 and on companies like NVIDIA that are clearly in the pole position for the growth in AI proliferation. So we're just saying maybe they're just better opportunities elsewhere.
Okay, so aside from small caps for a second, are the better opportunities within a rotation within the S&P and just sort of more of the cyclical sectors like financials, or is it going to be in, say, mid caps?
No, so we definitely like some sectors away from technology. We like industrials. We love healthcare, biotechnology in particular. Biotech in general is expected to grow earnings 16% next year, and we're seeing a lot of innovation in that space. So industrials, biotech, certain areas in financials for sure. And then in terms of market cap, we're also seeing the opportunities in small cap and mid cap for the reasons that I mentioned earlier. And then we're actually seeing opportunities overseas. Obviously overseas internationals underperformed the U.S. for a long, long time. But the valuations, again, have gotten very disparate, and we think there might be good opportunities there.
Hey, Mark, where overseas?
Well, we see opportunities in parts of Europe. We see opportunities in emerging markets because they're growing their exports, and they're also growing per capita income. So a country like India, where we're seeing economic reforms and per capita income is growing, obviously a very attractive market, and I think that's well understood. I'm not telling you what you don't know. And then we're seeing opportunities in markets like Japan, where we're seeing governance reforms and just more shareholder-oriented companies presenting, good entry points today.
Do you worry at all, though, when you consider some of the government policies out there and this idea that you could see a little bit more contention between some of those economies that you're talking about, that provides it raises a certain level of risk for U.S. investors invested in those spaces, and for that matter, foreign investors invested in the U.S. space?
Well, sure. And I think when we look at the policies of the new president and his administration, probably the one that we are most concerned about is the trade barriers and the inflationary impact they could have, not only within our economy, but other economies, and also just the interruption in free trade between countries. So it's something we're monitoring. We think that it's probably going to be more focused versus China. So, conversely, European companies that export to China might actually see a benefit from a more restrictive trade policy between the U.S. and China.
Mark, always great talking to you. Marc Pinto, head of America's Equities with Janus Henderson Investors, counting us down to those closing bells. 2.5 minutes away. Stocks right around session lows here. And S&P pulling back, Alex Steele, by about 0.5% right now. The Russell now down 1.4.
Okay, I'm looking forward to Broadcom also.
Yes,
that company crossing about 15 minutes time. It's had quite a run for the year, about 62%, and they're sort of in a great spot in terms of their cyclical business, like, say, chips for cars and smartphones. Does that really recover? And also the fun, cool new AI stuff.
Yeah, it'll be interesting is what they say. Remember 3 months ago, that report they gave us rattled a lot of investors. Maybe they course correct for that in just a few moments' time. A full breakdown of all of today's action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through the Closing Bell, a global simulcast. It starts right now. Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms here on this Thursday afternoon. A big turnaround from what we saw yesterday with the NASDAQ 100 hitting a record high, now pulling back 0.6% as we get closer to the closing bells today, Carol.
Yeah, absolutely, Romaine. A different tone, a different sentiment. You've got the number of falling stocks outnumbering rising ones for a record 9 consecutive days. You do wonder about that sentiment, what it's telling us maybe about the broader trends and where stocks go from here.
Okay, so we are rounding out earnings season. We got Broadcom in a few minutes. We'll hear from Costco a little bit later, too. We'll see what they have to say. And then, of course, next is the Fed. All attention turns to what we hear from Jay Powell and co. on Wednesday.
Yeah, no Fed speak until then because everyone's in blackout mode. So it does feel like we're kind of marking time until that Fed decision, even though it's pretty much baked in. We're going to get that 25 basis point rate cut.
Which then raises the question about the breadth that we've been talking about. BTIG was saying that, look, if we can't get the breadth and that rotation into breadth right to the end of the year, that doesn't bode well then for January and that broadening of the rally.
Just playing devil's advocate here, though. But, given that we're, 2.5 weeks away from the end of the year, 3 weeks from the end of the year, should we read too much into some of the price action?
No.
I feel like some people are starting to step away.
No, but you should definitely still tune in to our show at 3 p.m. every day, just in case to get us caught up on that price
To that
action.
point, I got an IB from somebody, a loyal listener and viewer, who said he's already on his way to California to ski for the season. So, yes, people are already leaving.
They already have snow there?
They have snow.
Or fake snow.
Tahoe.
All right.
Yeah.
All right, we get the closing bells here in New York. You can't see them, but trust me, they're actually happening right across the screen for the major indices here in the United States. The Dow Jones Industrial Average down about 200 points or so, roughly about 0.5%. A similar percentage drop for the S&P 500, which is going to close out the day right around 6,051 as we wait for these numbers to settle. The NASDAQ Composite down more than 100 points or 0.7%. Your biggest decliner, though, amongst the major indices, that will be the Russell 2000, losing 33 points today or about 1.4%.
Kind of like thrown off by not hearing the bells. I'm just going to put that out there. Right?
Yeah.
Large caps, S&P 500.
Like a reverse Pavlov's dog or something.
Exactly. In the S&P 500, 326 names to the downside. So overwhelmingly kind of risk off. 174 names in the S&P gaining ground today. Scarlett, 3 unchanged.
Did Trump take the bell with him after he owned it? Something. They have a bell there, right? Okay, sorry.
Very funny.
Let's look at the sector performances because we really saw some of the upside melt away as we got closer to the closing bell. There's only one sector that finished in the green, and that is consumer staples. Although real estate investment trusts and utilities fell less than the other sectors. So there's definitely a defensive tilt here in today's market. The worst performers are consumer discretionary and healthcare, losing 0.8%, along with communication services.
Can't be all that bad, you guys. Among my top gainers, actually the number one that I'm looking at is an IPO. So who said IPOs are dead?
That's interesting.
I know. Service Titan. Check this out. 42% in its first day of trading. It's a home repair software business. My home repair software business is known as my husband. I'm just going to put that out there. So the company soaring in its first day of trading, pricing above a marketed range, raising nearly $625 million in what could be probably the last major IPO of the year. So yeah, this one went off without a hitch. Doing pretty well. All right, another name doing really well is Warner Brothers Discovery. This is your top gainer, I believe, in both the NASDAQ 100 and the S&P 500 today, guys. It's up almost 16%, so pretty much closing just off its highs of the day. Warner Brothers Discovery changing its corporate structure, creating separate divisions for its cable and streaming businesses. So now we've got, the media company, so CNN and HBO, and it's also creating a global linear networks division, housing its cable brands and news and sports. So, and then it's got the streaming side, so dividing it up. But that one really an outperformer. And then one more, courtesy of Tim, Riot Platforms. The stock up almost 13% at its highs, finishing the day with a gain of just shy of 5% today. Wall Street Journal reported that activist investor Starboard Value has taken a significant position, I'm using quotation marks, in the Bitcoin mining company. Stock's down 16% year to date, and about 14% of the float is shorted. But nonetheless, pretty much a bullish day today.
I'm always trying to get Carol to talk more about Bitcoin.
Always.
So that's how I succeeded today. Talking decliners, 13.7% to the downside for Adobe. The company gave a disappointing annual sales outlook. It underscores anxieties that Adobe may lose business to emerging AI-based startups. We did speak to an executive there a little earlier in the program today who did say that, again, brand safety, the idea of making sure that what they train their products on is not copywritten material is their competitive advantage. Some analysts do say that the guidance was a little conservative, so we'll have to wait and see how things do shape up for the remainder of the quarter, and then, of course, next year as well. Adobe shares down 13.7% today. And then Nordson shares in the S&P 500 among the worst performers on a percentage basis, along with Adobe in there, down 8.2%. It's a diversified precision manufacturing tech firm. It serves more than 30 industries: aerospace, agriculture, automotive, plastics and textiles. You name it, they play in adhesives, sealings, coatings, and the like. So they got a great view on what's happening in the economy they operate in and sell around the world. They did report sales that gave guidance for the full year that analysts considered weak. Shares fell 8.2% by the end of the day today. And Stitch Fix shares soared yesterday, more than 44%. The company raised its forecast for full year net revenue from continuing operations today, coming back to earth a little bit, down 30%. Alex.
All right, let's get to the bond market. Really interesting price action. You saw a sell-off across the curve. I do want to point out we saw a pretty steep sell-off over in Europe as well, particularly with Italian yields. So the U.S. market really following Europe as well with that selling. Plus, you had a 30-year bond auction, $22 billion. It was not great. It did not go well. There were really low direct bidders. It was the indirect bidders that had to step in. That bid to cover was pretty weak as well. So that sell-off mostly more so on the back end, the 10-year yield up about 6 basis points.
It was kind of interesting, too. I mean, I was looking at some of the options data, and you're actually seeing a lot of those long positions that we had seen on the benchmark 10-year Treasury now sort of being unwound, and not necessarily to a massive extent, but it is a big turnaround from what we saw even just 2 months ago, where everyone really was betting for potentially a sub 4% 10-year yield. And now you're starting to see bets come back on the table for something closer to 4.75. And of course, some people now saying we could get back up to 5%.
Yeah, right. Very different. And, you know, you think about what the Fed might say, that kind of gives some support to that maybe next week at its meeting. Hey, guys, the political and cultural shift that we've kind of seen, some would say, since the election, the outcome, Donald Trump getting back in the White House, what we are seeing on school campuses, at least some of them, especially Ivy League, is the resurgence of Republican clubs, if you will, at colleges.
I believe, get this, last year, only 15 people signed up to be in the Republican Club at Brown University. This year, it's up to 50, which is still a tiny number compared to
Brown,
the student body. But what it represents is the ideological shift, right, that we're seeing in the country, and even on college campuses, too, in the wake of the protests that we saw on many college campuses in the spring of this year.
And those college protests are what swung a lot of people to the Republican clubs as well. There's a great story here on the Bloomberg where at Dartmouth College, Alex Azar co-founded the Conservative Students of Dartmouth Club early last year. If his name sounds familiar, it's because his father worked in the first Trump administration.
And he has the same name.
Yeah, there was, I think it was an article in the Post that talked about how Barron Trump was really popular at NYU. Okay, what I loved looking at here, this is an article from the Wall Street Journal, and it has to do with Ozempic and food companies. So the theory was Ozempic was going to crush the snack companies, but apparently Conagra Brands is rethinking how they're marketing some of their food. They're rolling out a new label that dubs a selection of its healthy choice frozen meals as, quote, GLP-1 friendly, all part of an effort to pitch people who are actually eating less. They're not alone. Nestle is doing something similar with their food as well. But I thought that was really interesting.
What's different about the food, though?
I don't know. They're just labeling it. This is a marketing thing. It's and like if you're on GLP-1, you can still eat our food.
How can you make that claim, though? Because those drugs impact people differently. Like, I don't know. This makes me a little nervous.
I think it's more just they're all high protein and low calorie counts, and have a good source of fiber. So they kind of have the right mixture of things that people who are taking Ozempic are looking for.
So it's not necessarily that they're
oatmeal.
It's not necessarily that they're coming out with
missing something?
Different foods. They're just saying, okay, these are the foods that are out that we have right now.
Oh, I got you.
And we'll label these GLP-1
Right, we'll label it for you
Well,
so you don't have to look too hard.
Apparently, we're thinking like pineapple chicken and a little beef merlot. They're pairing well. They have that protein at the end of the day. I think Restoration Hardware is out, having a pretty big jump right now, right?
Yeah, up about 15-16% here in the after-hours trade, even though net revenue pretty much just in line with estimates, $811 million and change, which is right on the nose of what the street was looking for here. I got to dig a little bit deeper here to see the bottom line numbers, but overall, you see the price reaction there on your screen.
Yeah, and stock's doing pretty well this year already, up about 30%. So you're building on that. So watch for that one now. It's up about 16%. So interesting to see that pop that we're seeing. We'll look for some more numbers, but as you said, in line. So it'll be something we'll carry over into the Friday trade. All right, guys, that is a wrap. Our cross-platform on to Broadcom we go, which we'll get a little bit later here today, but looking forward to that one. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We'll see you tomorrow.
A lot more coverage coming up here on Bloomberg Television. We're going to get some more details on those numbers out of RH. We're also awaiting earnings results out of Broadcom. And of course, that would come on the heels of a major announcement with Apple. A full breakdown when we come back. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Let's take a look at how markets performed on the day, Scarlett, because they did not perform well. An interesting turnaround from what we saw yesterday when the NASDAQ 100 hit that record high. The S&P flirted with another record high, but that all got unwound just a bit today. The S&P down about 0.5%. You see the Philadelphia Semiconductor Index providing no help as we do await those earnings out of Broadcom, the big chip maker there. And you see your two-year yield still camped out around 4.2, a bit of a holding pattern here. I'm not sure where all those animal spirits went. Yesterday, we were talking about Bitcoin back above that $100,000 mark, still straddling in the line, but you see the downdraft we've got today.
Yeah, animal spirits taking a bit of a break right now, but you ended it with Bitcoin. So I want to look at a Bitcoin miner, which is Riot Platforms, gaining almost 5%. And this is after the Wall Street Journal reported that Starboard Value, the activist investor, has taken a significant stake. We don't know the actual size of it, but certainly this is one reason why the stock is up. Before today, you look at Riot stock, it's fallen about 24%, even though the price of Bitcoin itself has rallied about 142%. Warner Brothers Discovery, the best performer in the S&P 500 on the day, gaining almost 16%. The media company announcing it's reorganizing into two divisions. It'll be the streaming and the studio business, which includes the film studio and HBO, and then the cable TV networks, the legacy businesses. These changes will position the company for deal making in the future and also will be completed by the middle of next year. And Adobe, a big decliner here on the day, losing about 13%, falling the most in almost 2 years after giving investors a disappointing full-year outlook. Investors clearly impatient with the effort to monetize its AI features. It's getting more engagement for customers, but it's not able to actually make the money off of it just yet. Romaine?
All right, well, let's stay in the tech space. We're awaiting earnings out of Broadcom. That could come at any minute. The estimates on the street, on average, they're basically looking for EPS of roughly about $1.39 on an adjusted basis. And that's the bottom line from about $14 billion in revenue. But more importantly, people want a little bit more insights here into that big AI push and maybe some course correct from that somewhat startling earnings report that we got out of them 3 months ago. Mandeep Singh is senior technology analyst at Bloomberg Intelligence, and he joins us now to talk about, I guess, what we should expect.
I mean, it has to be AI revenue. And look at what has happened in the last few days. Amazon has come out and said they are looking to use their own chips for training. And every hyperscaler right now is in the process of coming up with a chip that can compete with NVIDIA because they don't want to be reliant on NVIDIA. That's where Broadcom has such a strong play because they're giving you the networking and connectivity. And look, they have exposure to Apple on the smartphone side. So that 20% revenue exposure is there, and everyone is scared Apple may source that, at some point. But to my mind, the big pie here is in training your own large language models, using your own chips. You don't want to get hung up on connectivity or networking. That comes way too lower in the chain. And so I think Broadcom's positioning is quite strong because every hyperscaler is looking to customize and use their own chips for the workloads.
So you mentioned Apple, and of course, there are some headlines over the last 2 days that really kind of threw us all for a loop, right? Yesterday, the information was reporting that Broadcom is teaming up with Apple to develop an AI server chip for Apple products. Then today, Bloomberg reporting that Apple plans to replace Broadcom's Wi-Fi and Bluetooth chips with its own. So net, does it come out ahead here with Apple?
I mean, look, Apple is adding one more layer of, kind of orders. So they're already a partner or they're a customer on the smartphone side, and they're looking to develop a data center chip. So I think it's additive.
All right, we have Broadcom numbers coming out right now. Let's just tell you what they are. Fourth quarter adjusted EPS of $1.42, topping the consensus estimates by 3 cents. Adjusted net revenue of $14.05 billion. That is a little bit shy of what analysts were looking for, which was $14.08 billion. As for the semiconductor solutions revenue there, $8.25 billion, or just under that amount. Analysts were looking for $8.05 billion. And the Broadcom first quarter outlook revenue, it sees it at $14.6 billion. Romain, that is exactly what analysts are looking for, $14.61 billion. Yeah,
we're going to get back to Broadcom in just 1 second. I just want to update our viewers. We did get earnings out of Costco as well. That just came down the pike here. Fiscal first quarter comp sales, including gas and FX, up about 5.2%. If you exclude that, it's up about 7.2% here. It looks like a beat on both the top and the bottom line. A modest jump in the shares, up about 1.8%. Meanwhile, let's get back to Broadcom, because that is the granddaddy that we're getting here in the after hours trade. And it does appear that on several of the key metrics they did beat. I'm not quite sure exactly what the commentary is on AI, but I want to bring Mandeep Singh back into the conversation, Mandeep. And this gets to this idea that as they sort of put the narrative on the conference call and beyond, for that matter here, the progress that they've made so far through this most recent earnings period, are you satisfied?
I mean, look, they cater to so many different end markets. Some of the end markets right now are going through a phase where they're bottoming out. But to me, data center is an incremental market for them. Mm-hmm. And the fact that they're talking about AI revenue going to $15 billion next year, I don't know if they updated that in the print, but clearly it's to me, the drivers are very strong here.
They did say AI revenue grew 220% year on year, driven by the AI XPUs and Ethernet networking portfolio. So we don't actually have a value, but the 220% number is there.
I'll just cite Google as a customer. So Google TPUs use Broadcom, and Google is expected to be around, $3.5 billion in revenue for Broadcom. Mm-hmm. That itself could be a $10 billion revenue stream in the next 2-3 years if Google continues to build its cloud. So that's an example of an incremental customer that Broadcom didn't have, but they will have on the data center side going forward.
All right. Great stuff, Mandeep Singh with Bloomberg Intelligence. As we start to parse these earnings out of Broadcom, some interesting developments, too, that I just also just want to get to, too, because it gets to this idea of what Mandeep Singh was talking about, this idea of these companies and how a Broadcom fits into that space because of the unique nature of maybe what those chips and these GPUs provide. And that kind of feeds in to what our next guest has been trying to do. It's a company called Poolside. They partner with AWS, and they've announced a multi-year deal to make Poolside's generative AI assistant available in Amazon Bedrock. Enterprise customers are soon going to be able to customize Poolside's generative AI assistant for software development while keeping that data private and secure through AWS. I'm pleased to say that the co-founder and CEO of Poolside joins us right now, Jason Warner. And Jason, I do want to start off with what Mandeep was talking about the unique nature, at least in his words, of what Broadcom can offer in this AI race. Poolside, to a certain extent, also kind of fits into that same space. The idea of creating differentiation, because so many of the AI companies we've talked to over this past year and a half or so, they're all doing the exact same thing with the exact same data and a lot of the exact same technology. Where is the separation? Where's the differentiation?
Well, first, thanks for having me. And second to your question, you're exactly right. So most of the last generation of AI companies have all done the exact same thing because that's what they are about. They're building general purpose models, and they're building them for a general use case to be applied across the many different domains. We've taken a different idea and a different approach. We're building foundational and frontier AI, but we're building it specifically for software development. So we're building them for a very different target audience, for a very different use case. And our belief is that that is what comes next. After we've kind of abstracted away from general purpose, we're going to go towards different domains.
when we talk about going to different domains and about the proprietary nature, or at least the proprietary nature I think that most of these companies hope to have in building these things, how do you do that? If you're doing open source, or if you're using data that is either publicly available or you're getting from a third party, where do you get that exclusivity? Where do you get that intellectual property?
Well, I think the dirty little secret of the AI industry is that we all have access to the exact same training data. So if you're a frontier AI model company, and we'll call them OpenAI and Anthropic and some of the hyperscalers as well as us, you're all trying to do the exact same thing. So where your differentiation is going to come in is going to be either products you build on top of it, how you verticalize, or possibly how you partner. And so what we are doing, and again, what we think comes next, is we're a domain-specific frontier AI company, and our partnership with AWS is reflective of that. AWS and Poolside are both focused on the end customer and the developer in this partnership, and we're going to build and we're going to distribute towards the developer end.
So Jason, your point of differentiation is that you don't need access to clients' proprietary data. I'm wondering what opportunities you might miss out on by not using open source data. What do you give up in that?
Well, to be clear, we're using the exact same training data that all of the other frontier AI companies are using, in that we are using an internet crawl and we're using the open source code data off of the web, although we have some proprietary filtering techniques that allow us to get to a much better model. Though we also have proprietary techniques that allow us to generate a mass amount of synthetic data so that our model can get better without requiring access to customers or enterprises' private data. Now, this is very different. We don't believe in what I call the devil's trade of trying to give you intelligence, but asking for your data in return. And so what we believe is many enterprises around the world, in fact, most, should not give away their private data. And so we're trying to do something slightly different. And that's all going to come through engineering.
Let me ask a dumb question. Why don't more companies do what you do and avoid that and use your own synthetic data?
I think because they've not been forced to up to this point. And I do believe that as we have success, or as the world understands what they're trading off by using some of these different approaches, if I'm honest with myself, I think my competitors are going to figure that out, and they're going to start coming after us in new and unique ways. And as you hear more people say they're going to start using synthetic data, specifically synthetic data for software development, you know that they're kind of understanding what the game is now.
Jason, when you look at the broad landscape here, when it comes to AI, generative AI, and all the data that's being fed into it, what is the end game here? Because there's been a lot of talk, and I'm kind of speaking to our viewers who are investors. They're looking to make money off of this space, and it's hard to know where that money is going to be made. Yeah, you can buy NVIDIA, you maybe buy Microsoft and Alphabet, but there's got to be a bigger universe of investable opportunities down the road. I'm just not sure I know where that's going to be. Do you?
It's a confusing time for everybody. And I take a particular view, which is I try to distill things down to what matters and what doesn't matter, and over a long enough time horizon. And in my view, over the next 10 years, a 10-year time horizon, there's three broad categories of things that will matter. It's going to be access to electricity or energy, having access to the chips that make and run these new emergent intelligence layers. So the three things would be energy, the chips that make and run, the new intelligence layers. And so if you have exposure to any one of those layers via some mechanism, I think you're in a good shape.
Jason, in October, you announced a $500 million fundraise. I'm curious whether you're going to need to do another fundraise in the next 6 months and what the environment looks like right now, given all the optimism around AI and, of course, the new influence of Silicon Valley in Washington.
So we won't need to do a fundraise, but we may opportunistically try to do a fundraise. And the way that we look at this is that all of the dollars that we raise effectively are going towards training more capable AI models. And if we see the opportunity to pull very far ahead, or from a capabilities perspective in the models, or if we can accelerate on the go-to-market side, we will do so. And I do think that there is a chance to educate. Washington has very traditionally in the last couple of years, either intentionally or unintentionally misunderstood what AI effectively is and understand how it can be applied and benefit society. And I'm very hopeful that we can start to educate, Silicon Valley can start to educate Washington a little bit more here.
All right, well, we'll look to get you back on once we have more evidence of that. Jason, appreciate your time. Jason Warner is CEO and co-founder of Poolside. Let's talk a little bit about AI and the tech industry and what it means for states specifically, because a recent assessment of the California state budget finds that the upcoming fiscal year is actually quite balanced. And the key to this has been a booming stock market from high-income workers, many of whom are, of course, optimistic about AI. Incoming San Francisco Mayor Daniel Lurie tells Bloomberg TV that working with AI firms like OpenAI is critical to the city's economy.
Sam Altman has been great as a transition co-chair. We are committed to leaning into being the home of AI. We have historic investments already here in San Francisco. We're going to continue to lean in.
Joining us now for more on today's Muni Moment is Gabe Petek. He is a legislative analyst for Legislative Analyst's Office in California. Great to speak with you, Gabe. I guess the first question here is this balanced budget is better than what your office had initially anticipated. What's the single biggest reason why? I mean, I know that you make forecasts, but even you were taken aback.
Yeah, well, thank you for having me. And that's right. You know, the state budget has improved over the last year or so. And what we're seeing right now is the state budget, as we look ahead for the upcoming fiscal year, does appear to be roughly balanced. And that's even though our expenditures are higher than had been assumed back in June when the policymakers adopted the budget. And the reason that it remains imbalanced is that we are seeing pretty robust revenue growth. Our revenues are about $7 billion higher than what they were back in June when the budget was enacted.
So this is good news for the state of California, but it's not necessarily going to be something that's durable, because at the same time, you still have deficits in your forecast. At what point do deficits reemerge?
That's right. That's exactly the issue. We describe the situation as actually rather precarious because all of these gains that I just described are coming from income taxes, and the bulk of those gains are coming from gains accruing to people that make high incomes, people that receive restricted stock units, capital gains, bonuses, this type of income. It's not your hourly wage worker or salary earner. It's coming from these high income taxpayers. And that's very correlated with how the stock market is doing. And so if we have a reversal of the stock market in the coming year, it could really weigh on the state's fortunes. And because this strength in the revenues right now is tied to the stock market, we can't predict that with good credibility into the future. So we're assuming a return to more historically normal rates of revenue growth. And when you do that and you compare it with the expenditure growth that we see in our forecast, what you see is the emergence of deficits in the very first year, 2026, 27, after the upcoming budget year.
But Gabe, how does this tie in, though, when we talk about the appreciation in asset prices? I mean, that goes hand in hand with an appreciation, in theory, you would, of what these companies are generating in terms of cash, revenue, and obviously profits to some extent or another. So kind of square that circle. I understand that if you get a market reversal at the end of the day, that doesn't necessarily mean that the company behind that one particular stock is somehow not generating the revenue and i.e. the potential tax revenue that would come out of that.
Yeah, well, what we're seeing is that the economy of California, the regular economy that you think of, is actually rather lackluster. It's actually been gradually declining over the last 2 years. The state of California has not added any new jobs outside of government and healthcare in the past year and a half. And so the valuations of these firms is really propping up our revenue trends and our revenue collections. And the way that it does that is through the compensation to these high income workers. And even in the tech sector, they're not really adding a lot to the job base. They're really just increasing the valuation highly and then compensating their employees, and that's where the benefit is coming for the state budget.
Yeah, and of course in the markets we call that multiple expansion. It's something we've talked a lot about. I am curious though, particularly when it comes to tech, and let's just talk about AI, because a lot of people are drawing parallels between the AI boom and maybe what we saw during the internet boom in California in the 2000s and the early 2000s, and of course the actual computer revolution in the 70s and 80s. Is it possible, given that a lot of these AI companies are domiciled in California, is it possible that at some point we do see meaningful and material and tangible growth in those companies in terms of hiring, wages, and everything that goes along with it?
Absolutely. I mean, our forecast is, I hope if anybody looks at it, what you'd see is a fair amount of humility here. What we're saying is the revenues this year look pretty good. It's difficult for us to project that growth rate continues into the subsequent years. It could be, that we're experiencing the peak of the market right now, and there's a downside, but there's also an upside, and it goes to exactly what you're saying, Romaine. There could be that this optimism around AI that's fueling the markets is warranted. You also can't forget, the Fed is in the course of easing monetary policy. And what we've seen over the last couple of years in California is that the state's economy seems to be quite sensitive to interest rate policy. And so if that trend continues, that could also help us.
All right, Gabe, great stuff here. Really just fascinating to me, being an outsider looking in to, of course, the biggest economy that we have in this country. Gabe Petek over at the Legislative Analyst Office in that state here. A closer look at the impact, or maybe the lack of impact, that all that multiple expansion in the tech space is having on its budget. We want to stay in the tech space and turn back to chips, of course, with those results out of Broadcom as that stock continues to rally into after hours trade. But as we talk about chips, we have to talk about the political climate. Companies like NVIDIA, they're going to continue to provide goods and services to customers in China. At least that's what the company has confirmed in a post earlier today. And that was in response to rumors that it would actually halt sales in that country. That was after China opened a probe into NVIDIA earlier in the week over suspected antitrust violations. That probe comes as sanctions and tensions escalate once again between China and the U.S. We want to bring in somebody who literally wrote the book on this topic. Chris Miller is the author of Chip War, The Fight for the World's Most Critical Technology. The book covers the decades-long battle to control microchip technology with the U.S. and China increasingly in conflict. Chris is also a professor of international history at the Fletcher School of Tufts University. And Chris, I am curious about the relationship right now between the U.S. and China. It became very fractured during the Trump administration starting in 2017. The Biden administration really didn't do much to try to repair it. In fact, some would say that it's probably not any better than what it was when Trump left office. And now Trump's coming back in about a month's time, and he's basically promised to ratchet up the pressure once again. When it comes to chips, and particularly in the context of this whole AI revolution, is there any hope that there would be cooperation between the two largest economies in the world?
There will be cooperation in certain spheres, but at its core, competition is how both countries see the relationship, especially when it comes to AI. And I think you're right to put chips in that context because it's advances in semiconductors that have made advances in AI possible. And when it comes to advanced chips, it's the US plus Taiwan and a couple of other countries that hold all of the key cards in terms of manufacturing the most advanced chips. And that's exactly why the US has been doubling down, trying to restrict China's access to these ultra advanced chips for AI purposes.
How effective can these initiatives be in terms of trying to block one country from accessing your chips and vice versa? I interviewed someone a couple months ago, and he had a great quote. He said, look, technology really doesn't have a border. If you want to get your hands on this chip, you can. And Bloomberg just last week reported about how Russia, under heavy sanctions, has managed to get its hands on a lot of sophisticated chip technology from the U.S. using backdoor channels.
I think if you're talking about an individual chip, there's no doubt that a country as big and as influential as China can get access to a number of those chips. If you're talking about tens of thousands of those chips, which is the number you need to start to train sophisticated AI systems, that begins to get more challenging. And what's more challenging still is if you're talking about access to the machines that are used to make chips, which are the size of a school bus, have hundreds of thousands of components. It's now been 6 years since the US and the Netherlands have begun restricting sales of the most advanced chip making tools to China. And we've seen zero evidence that any of those have arrived in China. So I think when you look at the tools that are used to make chips, those restrictions have indeed been as effective as had hoped. And if you look at the chips themselves, yes, there's smuggling, but it's also the case that if you listen to leading Chinese AI executives, they'll publicly state their biggest challenge is accessing the quantities of chips that they need to train AI systems.
How long, Chris, would it take China to build up its chip industry, given all the restrictions and the sanctions and the limitations that are imposed on it right now? How long does it need?
Well, it's been spending the last decade trying to build up its chip industry and has made some progress. In 2014, Xi Jinping first identified chips as what he calls a core technology. But the reality is that China is still behind the US, Taiwan, the Netherlands, Japan, other countries when it comes to some of the hardest aspects of the chip supply chain. And so if you look at the most advanced AI processors manufactured in China today, the manufacturing technologies they use are equivalent to what Taiwan could do 5 or 6 years ago. So there's still a pretty substantial gap, and that gap hasn't really closed much over the last decade. It's been a 5-year gap for a pretty long period of time.
Okay, that's really interesting. I haven't heard it quantified quite like that. You brought up Taiwan. Is Taiwan more friend or foe in the U.S.'s effort to rebuild, reshore its chip industry?
Taiwan is very clearly a friend, but it's a complicated friend in a dangerous region. And I think the U.S. has been, on the one hand, very open about the fact that it values the technology relationship with Taiwan. Partnerships between companies like NVIDIA and TSMC, or Apple and TSMC, have been core to Silicon Valley's success in recent years, but also that having 90% of the world's most advanced chip production in Taiwan, including 99% of the production of the world's AI processors, is just an unsustainable amount of concentration. And that's why the US, as well as Japan and Europe, have been trying to diversify the manufacturing base of the chip industry.
I am curious about, we talked all year long about maybe what looked at some point like a potential rebound in Intel, obviously a homegrown chip maker. Obviously, they're having a lot of issues, of course, with the new CEO and everything else. But do you see a future, Chris, where the U.S. can sort of get back to those sort of, go-go days where we really were manufacturing our technology here in the U.S. and doing it at a relatively cost-effective way?
I think the chip industry has become so globalized that no one is ever going to be fully self-sufficient, and that shouldn't be our goal. But I think it does make sense for a country as large and sophisticated as the U.S. to try to have at least some volume of high-end manufacturing domestically, in part because if we don't do it, if we don't lead the diversification, no one else except the Taiwanese are going to do it. And I think we've seen some pretty important successes of TSMC, the leading Taiwanese firm, building up their capabilities in Arizona. That matters. But Intel, you're right, is going to be another key aspect of this equation. And a lot, I think, depends on Intel's ability to turn itself around.
All right, Chris, really appreciate your joining us. We'll be checking in with you a lot more frequently in the years to come, certainly, given this fragile relationship in the chip industry and the tensions between U.S. and China. Chris Miller is professor of international history at the Fletcher School at Tufts University. And we've been talking about U.S.-China relations. I always thought it was super interesting that President-elect Trump extended an invitation to Chinese President Xi Jinping to attend his inauguration. Such a flex.
Yeah, I guess it's a good overture. CBS reporting that Xi Jinping is not going to show up. But I was curious about this. Is this common? And apparently it's not.
No.
They were actually saying that basically what happens is they usually will invite the ambassadors or some sort of
which makes sense.
Lower level service, because the idea is that you don't kind of want a world leader showing you up.
Right.
It's your day. You're supposed to be about the U.S.
And the ambassador serves you in many ways.
And the ambassador serves them. So interesting. But again, interesting that he would actually even extend that invitation, and maybe it says a lot about what his approach is going to be to China and Xi Jinping once he does formally take office in about a month.
I think it kind of embodies his approach, which is you can't predict what's going to happen. It's basically, I'm going to keep you on your toes.
Yeah.
All right, let's take a look at how markets closed on the day. Down day, a lot of red there with the S&P 500 losing 0.5%. But, that 0.5% doesn't really show the scale of the declines, because you look at the sector groups remain, and it was, 10 out of 11 sectors in the red, with only consumer staples, a very defensive group, holding on to a gain.
Yeah, and there wasn't a lot of conviction when we talk about the rallies from the last couple of days to the record high on the NASDAQ 100 yesterday and the record high in the S&P was it last Friday, and you did not necessarily see strong conviction in that trade. It was enough to get it up to that record, but not a lot of conviction. And I don't know what people are waiting for. Maybe they are waiting for the Fed meeting next week, or maybe they're just waiting to the beginning of the year when we get a new Congress, a new president, and you start to see whether that big post-election rally was justified.
You mentioned the lack of conviction. I think that kind of sums up the approach to monetary policy as well. We're going to get a 25 basis point cut next week by the Fed, but in 2025, who knows what's going to happen, right?
I feel like it's going to be it's like the most begrudging 25 basis. It's like literally here, take your 25 basis points. No, but it gets to this idea, though, too, in all seriousness, that it's not really about the cut. at this point, it really is about what he says in that press conference and whether he's going to stand by what that last dot plot showed, which was still a lot of cuts for 2025.
Yeah, but as he's mentioned several times, that dot plot is not the be-all, end-all. It pretty much expires after
he
that.
Said that
after
when he
they
took
came
over,
out.
and yet he's still putting it out. He could have killed this. He could have killed the dot plot.
That would raise so many ires. I mean, that would get people all worked up.
All right, we're coming back in a moment. Stick with us. This is The Close on Bloomberg.
We want to take some time to remember David Bonderman, co-founder of the private equity firm TPG. He passed away at 82 years old this week. Let's go now to Bloomberg's Jason Kelly, who is joined now by TPG founding partner and executive chairman Jim Coulter. Jason, over to you now.
Thank you so much. I am really happy to be here with Jim Coulter. Obviously, a very sad day, Jim, for the team at TPG, for really the entire investing world. So first of all, condolences on the loss of your longtime partner, and thank you for spending some time with us here.
Thank you, Jason.
So David Bonderman, it's amazing to read about his impact on the broader investment world. He is one of the best known names, one of the icons. You knew him better than anybody in this business. What specifically did he bring to this business that was unique to him?
David really is a legend in the industry, but he's a legend for several reasons. And I think there's three particular things. First of all, he pioneered a type of investing. Secondly, he built a firm that had a distinctive place in the industry. And third, he had a really interesting personal style that I think helped evolve the style of this industry.
And so what did he do? How did that work in practice? Like what was he doing as a deal maker that really set him apart?
David did deal making as problem solving. So if you think about some of his signature deals, they were deals that everyone saw, but no one else was willing to take on. And it wasn't that he was taking on more risk, it was that he saw something different. Take the Continental Airlines deal, a legendary deal in the industry. The most hated company in America, the biggest bankruptcy in U.S. history. It sat there for 2 years. Dave and I put together a deal that carved out a new Continental and took it from worst to first in 7 years. It was, Warren Buffett said that airlines were financial sinkholes. David, over and over, made successful investments in airlines. When others saw the S&L crisis, David saw the S&L opportunity. We created the good bank, bad bank structure for American Savings when working with Bass, and then we exported that structure around the world to do bank rescues in China, in Korea. Again, deals that no one else did. And that problem-solving approach really appeared at a moment that the industry was mostly about changing capital structures, not companies.
All right, so you said something to me before we came on air, which I found fascinating, which is that David was a polymath investor. The Bloomberg audience is pretty smart, but you need to break this down, what that actually means in practice.
Polymath is from the Greek, and it's basically a person who has broad and diverse interests, but uses that knowledge and interest to solve problems. And so David really didn't come to investing until his 40s.
Yeah.
Think about that. He had several careers before. He was a litigator. He was argued in front of the Supreme Court. He taught law at Tulane. He studied Islamic law in Tunis. This was a person that never took a finance class, didn't know accounting. And yet he brought that broad experience and problem-solving expertise to the problems of investing. And his ability to use different experiences he had to solve problems, I think really created his style. And it's a polymath style. It was not one thing. It was a unique ability to see opportunity and, frankly, solve problems.
Well, and it translated into him being, I have to say, one of the most eclectic, maybe eccentric sort of figures in an industry that didn't always, certainly the broader Wall Street, doesn't always sort of embrace change. So how was he received in this broader Wall Street world, in your estimation?
Yeah, David was many things, but he was never boring. We used to laugh that David often brought like a rock and roll backbeat into rooms that were used to classical music. Yep. It was a very different style. He was known for his ridiculous socks. I mean, they were just ridiculous. When others were drinking fine wine, he was drinking Diet Coke. He flew 1,000 hours a year to meetings anywhere. It was a very personal thing for him. And his style was informal. It was direct. He couldn't stand obfuscation. And that style was sort of a different wind in the industry at the time. And it opened up the opportunity for different types of styles to really flourish. It's an industry that had incredible talent among its founding brethren, but David brought, I think, a little bit of a different attitude and frankly, a lot of fun into a very serious business.
And so how do you build a firm around that? I mean, that you can be sort of sort of an iconoclast as a single person, maybe as a small firm. You guys started out as 3 people in 92, 93, but now thousands of employees, $250 billion in assets. How does that sort of grow into something this big?
I've been doing this a long time. Culture and curiosity. So in some ways, what we described, you and I, about David became how you would describe TPG in some ways. At a time that the industry was very much about finance, was very much focused in New York, we came out of a family office in Texas. We set up on the West Coast. I used to say that, and you do sports a lot, Jason, that we were playing the same game but differently. We were the West Coast offense of private equity. And to do that, you have to get a culture of curiosity and problem solving. And I think at the first fundraise we did for TPG, our tagline was contrarianism, complexity, and change. At a time the industry was more focused on franchise businesses and finance. Contrarianism, complexity, and change. And I think those lines of problem solving and a different approach really were what David brought to the business in the early days.
Not afraid to take big swings? I mean, was that, part of his ethos, do you think? Like being able to really go big on something?
Yeah, it was never about ego or size. It was about really interesting problems. And sometimes we got it wrong.
Yeah.
If you're doing this type of investing, 5% of the time you'll make mistakes, and probably you should be taking that sort of risk. But the key is never make the same mistakes if you can help it. And importantly, learn from all of them. And David and I think our firm has been a lifelong learner on those. So I think somehow we've been able to grow with the industry, but still keep some of that essence of doing it a little differently and looking at new deals. I mean, even today, as you know, Jason, we've taken on impact investing, climate investing. These are new things, new problems done in a new way. And that ethos, I think, was what we started with almost 40 years ago. And we've tried to very much guard today.
How'd you build a partnership with him? You guys are not the same. You showed up in Texas, Dartmouth undergrad, Stanford Business School. He was a University of Washington bankruptcy lawyer, saved Grand Central. How does that marriage of a sort happen?
I think there's 2 types of partnerships. One are people who are very much the same, almost can complete each other's sentences. The other type of partnership are people who are very different but share the same values. And I think David and I brought different skill sets, different views of the world, but values on fairness, the idea of you can leave the last cent on the table to create a win-win. And we agreed on the type of firm and culture we wanted to build. So complemented each other, respected each other, but also brought some balance to the equation.
How do you think he changed you as an investor and as an executive?
I think David was, as well as being a great investor, simply a great business person. He served on 80 different corporate boards. Who does that?
Yeah.
80 different corporate boards, from GM to Ducati, from Behringer to Burger King, immensely diverse. And that viewpoint, something that was often underestimated with David, really helped me be a bit better businessman. Mm-hmm. It's about being straightforward. It's about seeing different things. It's about patience from time to time. And even when things go wrong, you don't step back, you step in. So I think his polymath skills really extended into the business world.
All right, I mentioned earlier, this is a massive industry at this point. What we used to call private equity, it's now alternative investing. These firms, including yours, are doing lots of different things. How do you take that Bonderman ethos, the sort of like, he's calling in to an investment committee meeting from Timbuktu to, now a publicly traded company. How do you maintain that essence? Because I know that culture is something that's important to you. You study it. How do you really institutionalize that culture?
Fight conformity in all ways. I think if you were starting this business today, sometimes I think the people who are looking at it feel they have to learn finance in their crib and have to go through internships. David came to this, as I said before, in his 40s. He brought that wide set of experiences. And I think the understanding that you can ask different questions, approach problems in different ways, is something the industry needs to stay true to today. So that spirit, the spirit of problem solving, curiosity, a little bit of courage, put together with a broad view is something the industry still needs today. And I think the industry is delivering that. Immense talent in the industry. We have to just make sure that it's not delivered in one way.
And so as he sort of kind of moved on from the firm, and we'll talk a little bit about what he was doing in the latter years of his life, how did you sort of honor his legacy? How did he stay involved?
Well, David always had broad interests, and one of the interesting things about his career is he's mentored and spawned many businesses and helped many businesses, from Mark Lazary to Tom Barrack to Mark Stad to Wei Jing Shan. There are disciples around the industry that have picked up some of his investing style and ethos, and he continued to do that as he continued to have TPG as the cornerstone. But he went on, as you know, to be active in sports.
Yeah.
And yes, he had been an investor in the Celtics, but he did a typical Bondo thing. By the way, just the nickname Bondo was different in the industry. He did a typical Bondo thing, which is he took on a problem no one else would, bringing back a team indoors in Seattle, rebuilt an arena where he had worked as a security guard when he was an undergrad at University of Washington.
And we were listening there to TPG founding partner James Coulter, reflecting on the life and legacy of his business partner, David Bonderman, a legend in the world of private equity who passed away yesterday at the age of 82. As we wrap up today's coverage here on The Close, let's push ahead to what the markets will have their eye on over the next 24 hours, and that includes some monthly GDP data out of the United Kingdom.
A modest 0.1% gain for October, same as the month of September.
And then we go to the European Union industrial production numbers, 5 a.m. New York time, and then back here in the U.S., 8:30 a.m., we get that import price index.
Both import and export prices are seen declining month over month for the month of November, but gaining year over year.
And an eye on the markets here, and an eye on a shakeup in the NASDAQ 100.
Yeah, the annual reconstitution will probably lead to Palantir and MicroStrategy being added to the NASDAQ 100.
Yeah, it'll be interesting to see how some of the year's biggest winners get rewarded, at least for those that weren't already in the NASDAQ 100. We'll be back tomorrow. Balance of Power is coming up next, right here on Bloomberg